How's it going? Welcome back. It's Jonathan, and in today's video we're going to be taking another look at the crypto market. Now if you haven't already, go ahead and hit that subscribe button and hit that like button and also that bell notification, because it's that bell notification that's going to give you the update of when we post next. Now one of the questions I'm often asked is why I don't talk about any other cryptocurrency except for Bitcoin. So today I thought we'd take our first look into Ethereum. Now I will go over the Bitcoin market first and then we'll delve into Ethereum. I'm just starting some new research on Ethereum, so I'll just introduce you to what I'm learning, and then as we progress into the Ethereum currency, we'll get more of an understanding of how it moves and how it operates. So first up, Bitcoin. Let's take a look at where we are, where we might be going, and then we'll move on to Ethereum. So I've got the Kagi chart opened up first of all, and as you can see straight away, we're posting green on both the daily and the weekly. So we have had a strong green season higher. Now it was obvious, I'd like to say, when we get these green postings on the Bitcoin market, that we do generally rise higher. And when we get these red ones, we should be on the lookout for the market to turn lower. Obviously, not always do we get the market turning lower by a big magnitude. Sometimes it's just a few days or a slight reversal, such as what we saw on this daily price action, and also over here back in July and June. So when the market turns down, we always need to take it with a grain of salt, but we also need to take the signals as they come, because the Kagi chart is a pure buy and sell signal. When it turns green, that moment, so anything that you see on these videos are not buy and sell signals. I'm talking about what's already happened and then giving you an idea on what could happen next. But this is not a buy and sell signal service. So the only way to use the Kagi is to see it turn red or green and instantly act on it then. Once you've missed out on the signal then becomes void, invalid, and you need to technically wait for the next signal. So we can see that when it does turn green, it generally gives us an indication that the market is biased to the upside, and when it turns red, the market is biased to the downside. So for the longer it turns green and the further it runs when it's green, that is bullish and that is good for us. Now with price, so we have actually moved above our band for price. Let me go ahead and get my pencil up. So this was our band in here. We were expecting some form of congestion in the market. That didn't occur. The market did scoot above it, and that's pretty clear, so we don't need to argue against that. And the market has sort of started to move higher, and what you could determine a form of a pattern. Okay, so that's pretty interesting. This is not daily data, so the market actually has posted higher again. So we'll get onto the daily data very soon, but the market has moved up to around the 70,000 mark. The market has moved up to around that 57,000 mark, so it's still looking strong. But we just need to be on the watch out for any potential turn in the market, and that's the turn to the downside. So we'll keep going through a couple of charts and just seeing where we could and potentially meet resistance. So what I have here is I have the Elliott wave, and we were definitely watching the Elliott wave structure play out. So we have, as we can definitely see, the low has come in for potentially the second wave Elliott wave on a longer 5 sequenced Elliott wave higher. Now I don't think I actually showed you this, but we zoom out further. I did start drawing this from the 2018 period. We had our first wave up. We had our second wave down into the March low of 2020, and then we had our third wave higher, which came up 561.8%. So yes, it can continue to stretch beyond a 161.8 and a 261.8, which is this typical Elliott wave moves. If we're getting a longer and stronger push higher, the third wave can continue to move up multiples of that 100% on the 161.8. So 161, 261, 361, and it moved all the way up to the 561. Before it completed its third wave to the up move on the longer term scale. So when I'm talking about the third wave now, it's actually the third wave in the fifth wave, okay? So this here was the final top for the third wave on the longer term scale. And then we had our potential fourth wave, and now we're currently in our potential fifth wave. And then in the fifth wave, we then have a 5 subsequence, which would then give us our 5 waves to the upside. Now with Elliott wave, again, generally speaking, your first wave can move, so your first wave moves up. Once you get your second wave, you can get a second wave down into 38.2%. It can move down into the 50%, can move down into the 61.8, but it also can move down 100% of the move up. It can go down that much. As long as it doesn't cross below it, it's still technically considered a valid wave, okay? Let's go ahead and delete that one. With your third wave, so the market's moved up, it's moved down, and now it's moving up. The third wave is generally the strongest and the longest, generally. Not all the time, but generally. So it generally can move up the strongest over the longest period of time. Once the third wave starts to move down, you generally get your short and sharp fifth wave higher. That's generally how it looks. But generally, I think I've just said generally like 100 times right now. Typically speaking, in the Bitcoin market, what we get for this market indeed is we get sort of our slow and steady first wave, and then we sort of get the sharp sell-off, and it can come into that first period, for example the March 2020 crash, where it almost looked like it was going to go lower, and then we sort of get our slow and steady third wave higher, and then we get our major dips, and then the fifth wave is very short, very crisp, and very parabolic. So whilst the third wave looks like it's very strong, the fifth wave can actually definitely outdo the third wave. So that's something we've got to keep in mind. Now the price targets I've already put out for the fifth wave, and the first target is definitely this $100,000 mark. I don't think that there's much to go against that. Bitcoin could definitely hit the $1,000 mark. I think that would be very simple for it to do. And once it hits that, all we need to do then, if we're going to then continue to apply this theory, is we just keep tracking it up, and then that will put us at 125,000, and you do also multiples of. So you do 325, 350, and then 300, we got 361, and then you go straight up to your 461.8, and then start doing multiples of. Now the reason why we're doing multiples of is because we want to keep it with the sequence of the Elliott wave rules. Now the Elliott wave rules are pretty standard, but they're not foolproof, so you can't use this theory in a way that's going to be a definitive action. It's not just a science, you've also got to apply the art, and the art is the art of interpretation. So once you've got your rules in place, you then need to interpret how the market is moving. That's why Elliott wave is so subjective. And I was going through a lot of Daniel Farrer's content at the moment, and he talks about a 5 and a 9 wave sequence in the markets. And he said that what Elliott had actually done is he'd actually missed out on a large portion of the actual fractals in the market. And that's something I'm trying to look out for Bitcoin at the moment, is a potential 9 wave push higher. I think that could be something on potential on the cards right now. So I'll leave the Elliott wave here. We just need to see how it plays out and see where we get the next form of resistance for this third wave. So the third wave could definitely come up, potentially hit the 100% level, which is very similar to this one, find some congestion, or it could push through to the 161, which would put us up at around the 70,000 mark before. Again, these moves are very parabolic, okay? So this, we're talking like over the next 3 months. So I'm drawing lines out just to keep it clean, but we're talking like a parabolic move on the cards right now. So we'll keep this in mind. We could push up to the 161, get our move lower, and then do a parabolic shot higher into the end of the bull run. I think that the end is nigh, and I've said that 100 times, but these are the things that we just need to keep in mind, okay? So let's shift over to the mass pressure chart. Now the mass pressure chart is one that a lot of people are getting a little bit confused about. The mass pressure chart is not also very similar to the other information I'm giving, not a buy or sell service. It gives us an idea on direction. Now, the basis of my method is to be putting everything together and seeing how it fits in with the mass pressure chart, and seeing if the mass pressure chart can give us a clue on the direction of the market, okay? Now, a lot of people at the moment, when I put out the issue for a potential decline in October, if a decline doesn't happen, they're saying you're wrong. Well, not really. All I said is that if we do get a decline, the decline will be higher than the September low. I'm not calling for $20,000. I'm not calling for $40,000 in Bitcoin. I'm not calling for zero in Bitcoin. We already know right in front of us what the end of the year is potentially going to look like. And if the mass pressure chart is of any significance to a glimpse into what's going to occur, these little humps and bumps in the market, we're talking like a decline in the market of like 15% potentially. So when it doesn't happen, it doesn't mean that the theory is wrong. All I'm looking at is for these declines, because all I want to know is where's the safest area to be buying. You know, you have the option. You have the option of buying into a rally and potentially buying the top, or doing this whole dip buying strategy. Now, I prefer the dip buying strategy in a bull run because you're buying higher lows, which means you can more safely buy the market, and that's pretty much all it is. There is no right and wrong to this theory. We're moving up, or the bias is to move up into the end of the year, into the end of the cycle, and we're just trying to find the best places to buy. So if, for example, we don't get a decline in the October period, that doesn't mean the strategy is wrong. It just means that the market is actually stronger than we were anticipating. If we move up and we just keep doing this and we don't get any of these dips, obviously you can say straight up that it's potentially a negative thing for the market, because the more parabolic it goes, the more people are going to jump in, the higher the chance for a top. That's simply how it is. If you're trying to dollar cost average, get into the market in the dips to try and ride this final boom higher into its eventual peak, then you want to be doing it on these drops. Now these drops, let's say hypothetically the market dropped from $80,000 to $68,000. Where do you want to be buying? Do you want to be buying at $80,000, or or do you want to know that it already got to $80,000? Now it's down to $68,000. Hypothetically, these are not real numbers. And then from there, it could potentially move back up to $80,000 and then beyond. Where do you want to be buying? So again, it's all about interpretation of the data and not that this is an actual thing. So we got to see how it goes and see how it plays out. And then that puts us onto seasonality. So seasonality is an interesting one because we knew that our September month was seasonally expected to be a negative month. And then we have our October period here. Now, this little diamond shape here, I was going to say square, but definitely a diamond, it tells us where we are now based on seasonality. So currently the market has pushed up higher than what it usually does for the October period. So this period here like talks about standard deviation, averages and so forth. This period here is where most of the data is contained. Sometimes the market can push higher, but we're talking about averages. And currently right now we have pushed above what we'd consider as the average for the October period. So there is any chance that unless this month is actually going to be stronger than all the months combined, which could be because we're in a potential final bull market leg, there is potential that it might come back down into the average, which means the market would need to decline to finish the month not lower, but not as strong as it is currently around 12 days in, okay? Now what you would have noticed is that we were looking for a potential decline in the markets, especially for the Bitcoin market. It was going to potentially happen between the 10th to the 20th. That was sort of the mid-month angle I was looking at. So if we look back at the averages for the declines that can happen in Bitcoin around this time period, it is not out of the question that Bitcoin could, I'm not saying it will, but could decline around 15%. Now again, whether it happens or not, it's not really a right or wrong scenario. I'm not saying that it's 100% probability it's going to occur. If it does occur, those are the sort of pullbacks that we're looking for, and then that would give us a safer area to buy. So let's go ahead and take a quick look at the percentage. The market did drop around 6%, so definitely not anywhere near that 15% drop. So it's still potentially on the cards, but if it just shoots forward, that just tells us that the market's a lot stronger than it was in the past, and then that the cycle is more bullish than we were anticipating. That's all it is. We're just going to move forward from there. And that brings us to our squares. So let's take a look. So last time we spoke, we had a lot of congestion in the market around this area here. We can see that until the market broke out strongly, we had a lot of congestion. The market has come into this next sphere that we were watching, where the market came up to the 45-degree angle. Would have been good to see it hit this 220-degree angle on the latest move, but it's still around the 45-degree angle. I can't yet take it off the cards that we're potentially moving lower. I can't take it off the cards until we get a complete invalidation that between this period here, the market has just traveled higher and higher and higher with small and decent pullbacks and nothing like a potential 15% decline. So how much is a 15% decline hypothetically? Let's use this 45-degree angle and let's move down from this just as an example. So let's go ahead and pop that on. Moving down 15%, if it did occur, would take us down to the 50% level, which was a level we were watching. And then that there, oh, wrong tool, that there would put us around the 48,000 mark. So is Bitcoin going to 48,000? I'm not too sure, but if we can use past events and give us an indication of what may occur in the future, could be on the cards, So let's not rule it off just yet until we get a clear indication that the market's either moving up and it's going to ignore potential pullback, or if it does give us that clues. Now until then, let's say for example the market does push up. This is trading psychology 101. If the market does push up, let's say hypothetically, you look to gain, if it does push up to this level over this time period, you look to gain 8%. If you buy here right now, so if you're buying here right now and the market does decline, you look to lose 15%. I'm not saying you are going to lose, I'm just saying out of those two scenarios, what's more important over the next 10 days? Making 8 to 15% or being at risk of losing 15%? That's the probability, and that's the thinking you need to come to the markets with. What's safer? Now, of course, you don't need to think like that all the time. Anyway, I'll stop waffling. Let's move on to Ethereum. I think that's pretty important right now. All right, so let me go ahead and switch over to Ethereum. I'm not going to save any of that, so let's move on. Now, what I wanted to do now is I want to introduce you to some research I'm doing. Now, you already know that we're doing the square of 9 on Bitcoin. I want to now take a look at the square of 9 on Ethereum, and that way you can get an idea on why these levels are important and how they come into the whole picture of things. Now, I'm just going to move over to the static square of 9 information page on the Optimus website, and we'll just take a quick and brief look at it. So the static square of 9 tool calculates price levels according to degree levels or aspects of the square of 9 wheel. Now again, if you don't know what the square of 9 wheel is, let's go ahead and look at it. This is a square of 9 wheel, and you've seen it in the past videos and I've given you a high level overview of it. But this is the wheel, and it is a square root calculator based on GANN's research. Okay, so it starts with 1 in the center. And yes, if we go back, we can see that it starts with 1 in the center. When the static square of 9 tool is applied to a chart with a price unit of 1, the first 360-degree level will be 11. So that's from the 1 out until 11. So from the 1 to 11, that's a full revolution of the square of 9 calculator, and that's a full 360-degree revolution. The second will be 28, and the third will be 53. So we'll look at it here: 1, 11, 28, 53. And each time we go out to the left, it's a 360-degree rotation, and each time we go to the right, it's a 120 degrees. So we're going 180 to 180 degree. So we're going 180 degrees around a circle, and then we're doing a full revolution 360 degrees around the circle. So looking at the classic square of 9 wheel, you'll see that there are numbers. You'll see where these numbers appear. They're all on the horizontal line to the left of the center value of 1. As each number is one complete revolution around the square of 9 from the previous number, they are said to be 360 degrees apart. Similar, like the 180 degree levels, are halfway around the center and are directly opposite the 360. So if you take a circle and you put 360 up the top, and you got 180 down the bottom, it's complete opposite, okay? Okay, so whilst the 360 degrees apart from each other, they are the 180 degrees from the center. You'll see this relationship, blah, blah, blah. The square of 9 is also known as a square root calculator. Pick a number on the chart, take the square root, add 2, and re-square, and you'll see the value will be the next number on the wheel. Each rotation around the wheel is further to travel. The distance between 360 degree levels grows wider and wider with each revolution. And they give you an example here. So the distance between the first and the second 360 degree level is 17. And that was the 28 minus 11, which was the 28 minus 11, which equals 17. And the third, but from the third to the second, the distance is 25. So that's 53 minus 28. Many GANN analysts use the degree levels as potential support and resistance points in the market, and they work for any instrument in any time frame. And that's the same for anything. Price analysis, time analysis, cycle analysis, Elliott waves or fractals or anything like that can work in any time frame and in any market. The image below shows the Australian US dollar pair on a weekly chart with the static square of 9 applied. The degree levels use the semi-square, such as your 45 degree angle, 90, 135, 180, 225, 270, 315, and 360. As you can see, the chart has respected these levels on multiple occasions. In fact, at the time of writing, the 225 degree level, or 73 cents, is providing a level of support. So what I am doing with the static square of 9, when I pop it onto my chart, is I'm trying to find a level where the market is respecting based on the static square of 9, so going down to the square root calculator and all that sort of jazz. And I'm just trying to see where the market is respecting these levels. So what I want to do is I want to go back in time, and I want to start with our square of 9, and I want to pop them all on the chart. Now, if I didn't make it clear enough, if we go back to this point and we go from this green one here to this green one here, in price at the moment, we're looking at 74 to 22, so to 20. This here is a 360 degree revolution in price. Likewise, if you move and you go to the next one, this here is a 360 degree move in price. Now, as you can see, the gap between this one to this one and then this one to all the way up here is actually bigger, and that's because as the chart, as the website said just a moment ago, each time you move out a sequence in a 360 degree rotation, whilst it's 360 degrees in price, the difference between each level actually gets larger and larger and larger. And that's why this is a static square and not a dynamic square. As you can see, we move out even further, this one to here, and then all the way up here is another massive jump. So now instead of jumping just 50 points, we're now jumping over 100, and it'll keep going and going and going. So using these levels, I need to find out which levels are likely to provide the most significant support and resistance. So the ones I have put on here are the 90 degrees and the 180 degrees, which I believe are the most significant. And then the two minor levels I've used are the 270 degrees and the 360 degree level. Again, you might be thinking, didn't you just say that the green one down here was a 360 degree move to the one that was up there? Well, yeah, so it's a 360 degree move from where it is on the square of 9. It's not a 360 degree move based on it being a 360 degree angle, okay? So if we go back to this square of 9, if we move out this way, that's a 360 degree rotation. If we move this way, this is a 180 degree rotation. Moving up, we get our aspects, and moving down, we get our aspects. Now the most common ones are your 90, 180, 270 degrees, and then all the way around to your 360 degrees. So 9, 18, 27, 36. So that's pretty much that in a nutshell. So when I've got this on the chart, what I'm looking for, as I said, is I'm looking for the most significant areas where price has clustered. And I'm doing that based on one tool alone, and that's the square of 9 calculator. So when I go ahead and pop on the levels, I'm looking for, if we were to bring this out, where were we getting any form of resistance? And we're starting to get a few hits. If we move it forward in time, where are we getting hits? Where are we getting hits? Where are we getting hits? Well, as we can see, this level here was hitting, this level here was hitting. We've got a hit here, we've got a hit here, hit here, a lot of congestion here, congestion here, congestion here. So these levels here are providing significant congestions in the market, and these are just natural levels. So the best thing about the square of 9 calculator, in my opinion, is that it helps us to look into the future on potential areas where price may find support or resistance. So let's say, for example, you're doing standard support and resistance analysis. Now, standard support and resistance analysis will give us an indication that this level here had a lot of significant support. So if we take this out into the future, then we could see that the market is likely to meet support or resistance on that level again. Likewise, this level here, if we move it out into the future, this level here could provide us a decent amount of support or resistance in the future. But what happens if we're moving into the future and there is no data? So let's say, for example, this is where we are at the moment, and we don't know if when the market moves up, where it may find support and resistance to the high or low move. Well, that's where the square of 9 can give us a natural support and resistance assumption. So let's say, for example, the market was to hit this top here, and then it was to turn down. Well, how low can it go? Well, first of all, we have our first, second, third, fourth, fifth, sixth, seventh resistance levels that are there, and the ones that we could watch. That's what I'm trying to get at. It helps us see levels in the future that are not yet posted to both the downside and the upside of where the market could find support and resistance to those moves. So let's go ahead and just keep looking and seeing where these markets respected these levels. A lot of congestion in this area. We'll go ahead and just keep moving on. As you can see, hit here, 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 and we just want to see how many times and how often these levels are respected and then move forward. Now, the reason why we want to know how many times they're hitting is because there are dozens of support and resistance levels we can put, again, all divisions of that circle. And if we use our 45-degree angle as the basis, so we're dividing the circle into 8. I've already introduced you to 8s before. If we put every single one of these levels on, well, we're going to get too many levels and it's going to be too complicated. So we want to find, of course, the most significant levels. And that's why we do it like this, the most significant levels. Let me get my significant level back on. Now that we've got an idea on what the significant levels, based on how the market's acted in the past, we can then use these levels to go into the future to see where the market may find resistance. Now, in my opinion, like I've already mentioned, the two significant levels are the blue one and the green one, and then the two minor ones are this pink one and this brown one. So let me break down what each level is. So the green one, first of all, is the 90-degree angle. Okay, so we're moving 90 degrees around the square of 9. And then the blue one is the second most important level, in my opinion, and that's the 180-degree angle. So that's the next revolution. The two minor ones were the 360 and also the 270. So what you'll see here is that we actually have the 180, the 270, the 360, the 90. So we've actually divided the circle up essentially into 4 parts. So these 4 parts here are this one and this one, left and right, up and down, around the cardinal cross. And it's no wonder why these are actually important levels. So now that we have these levels on our chart, we can actually move into the future, and we can see if we do all of our analysis. I'm going to break all these charts down into their respective fields like we were before, providing us levels where the market may find resistance into the future. Now, using this, again, if I want to look very far into the future, I can actually extend these levels into the future, so I can see how many, like each time I put a revolution on, it's a 360-degree revolution. I can see again how far out we're likely to move. So the first significant level of resistance is around the 4,600 mark, 5,200, 5,900, and then the other one is 5,700, around 5,100, and then around the 4,400. Now that we have those levels on, so let me go ahead and just write them. So 59, 57, 50, oh, can't write there, scribble that out, 52, 50, 46, and 44. What I want to do is I want to move over to another form of analysis, and let's say price analysis, for example, and I want to see if we get any form of similar research that is going to indicate that these levels are ones to be watching. Now what I want to do is I want to pop on, for example, a series of price extensions and so forth, and I want to see if it's possible to get any hits around the 44 to 46, 50 to 50, and 57 to 59. So let's go ahead and just put on, first of all, a price extension, and we get our 49 level. What I'm going to do is I'm going to add a few more divisions onto this. So I'm going to do 150 and then 200. And now what I want to do is I want to put on a 100% run of the last move to the upside. It gives us 535760. And then what I want to do is I want to maybe take a look at the most recent run lower and extend that higher again. Okay. So now we start to get a series of price clustering. Now let's go back to our squares for a moment, because we have this level here around the 44 and we have this level around the 46, important. And then we have this level here around 57 to 59, important. So if we look at this, we can start to see that there are potentially levels where the market may find some resistance. Now I like to draw my support and resistance levels in squares, so I'm going to put them in boxes. And the first one is going to be around that 49 mark, okay, so 4,900 mark, and the second one is going to be around this 59 to 6,000 mark. So there we have it. Instantly we have two support levels into the future that are just using two forms of analysis, price analysis and static squares, to give us a potential price clustering. So that's all I've done. It's very simple, and you can do it too. So let's go ahead and just keep these on the chart. I'm now going to save this. I'm going to clean my chart, and we're going to see how it plays out, because I think that there's every potential that, of course, these are USD terms when I'm talking about Ethereum and Bitcoin. I think that there's every potential that if the market's going to move up, we need to be watching the $5,000 mark and to round it, and the $6,000 mark to round it for this market as the two first major resistance levels. No doubt over time we'll be able to refine this as I get more research into the Ethereum market and find out on a more granular level how it moves, because I've been focusing a lot of my time on the Bitcoin market. But I think this is a good basis to start, and also gives you a good glimpse into the way I look at the markets and the way I'm thinking. So anyway, there's a current update on the cryptocurrency market and the Ethereum market. If you got any new insight out of this, go ahead and hit that subscribe button if you haven't already. Leave a comment below and hit that like button. And with that said, I really look forward to seeing you next week.